From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. I'm Kim Strassel here with Joe Sternberg and Alicia Finley. The Federal Reserve meets tomorrow, and there is another rate hike in the offing. Joe, I am old enough to remember when you go back to December that the median prediction of Fed governors and bank presidents was 4 25-point increases by the end of this year. By March, that median had become 7 of those 25-point increases and some more in 2023. Now we're looking at the Fed tomorrow maybe delivering a third sizable rate increase of 0.75. What do you expect to see, and is it going to be enough?
Well, the trouble is that we're all old enough to remember when we were expecting these quarter-point increases, because we're also all old enough to remember when the Fed was still claiming that this inflation was going to be transitory. And the bind that they find themselves in now is that they fell so far behind the curve, especially during 2021, when there were signs that inflation was starting to gather momentum, that now they are kind of pushed into these much bigger increases. I mean, what I think is interesting is that actually the market hasn't completely ruled out the prospect that you could see a full 1 percentage point increase at the meeting this week, even though investors think that outcome is not particularly likely. I think that sort of the speculation about whether the Fed might at some point have to go bigger than the 0.75 percentage point increase is a result of the fact that there's this growing recognition that the Fed sort of fell behind the curve, and it also has given up its capacity to surprise markets and create in markets and on the part of investors a sensibility that the Fed really will do whatever it takes to get inflation under control, even if that means surprising on the upside with a rate increase. So I think that we're now kind of at the point where the Fed has been refreshingly quiet ahead of this meeting and not leaking as much as it has recently about what its intentions might be. That's a good start, but they don't quite seem to be at the point yet where we can tell that they would be prepared to really surprise markets.
Yeah, I think that raises a really interesting question. I understand the problem of creating too much speculation. And Alicia, we had a really interesting piece in the Journal today by Andrew Levin and Mickey Levy, both who are Hoover Institution scholars. And they're making the case that the Fed doesn't really have a plan at all. That if you look back at most of its meeting this past year, it's focused on relatively minor disagreements on what it might do. And they make the case that the Fed needs a bigger, broader strategy because it's now risking serious, persistent high inflation. What do you make of that? Is the Fed, does it seem like it's in control of this situation? Is it projecting that? Does it look like it has an overall strategy? Or is part of the problem that it seems to just be wandering around here, unsure what to do month to month?
You're right on the latter. It seems to be kind of wandering in the dark here. And I think you can see that by the market's response to data and the announcements, the Federal Open Market Committee's announcements when they come, because they're not exactly sure how the Fed is going to respond to the economic data that's coming in real time. Our op-ed contributors suggest returning to the Taylor rule or some kind of price rule, which provides a little more certainty of how the Fed is trying to negotiate the environment, the inflationary environment tied to the prices. The markets are signaling with the volatility is that they don't know. Whenever you see a very positive economic report, jobs report, the markets are falling because they seem to be absorbing the lesson, or they seem to be believing that the Fed is going to tighten more because it seems that the economy is getting hotter. But then when you get a negative report, or perhaps, a manufacturing index falls, markets seem to interpret the other way and seem to think, well, maybe the Fed will scale it back a little bit and maybe they won't increase the rates quite as much. And so I think the markets actually are a very good indicator about the uncertainty of how the Fed is going about tightening, both through its quantitative tightening as well as its rate increases. And so much seems to be dependent on the real-time data. And I think the reason why 100 basis points is now even on the table is that the surprising consumers have proved surprisingly resilient, notwithstanding the prior tightening. And inflation is still continuing to run pretty hot, especially in the core index. I mean, energy prices have fallen, but the core hasn't.
Yeah, consumers have been pretty durable through this. And you have to ask maybe how much of that has to do with the pileup of savings that was accumulated during COVID, although at some point, presumably, people are going to spend through that. But, Joe, if you step back and we look at it more broadly, obviously, one of the other risks that the Fed confronts here is that if they go too far, too fast, that they can have a negative effect on the economy. And from that zoom back level, actually, you look, the United States essentially had no real growth in the first half of this year. And just recently, the Atlanta Fed, which puts out its GDP Now forecast, it's lowered expectations for third quarter GDP to 0.5%, which is essentially also no real growth. A lot of people are talking about recession, but one of my questions is, especially as we're beginning to see some corporations put out some glummer news, including news of layoffs, when does this begin to bleed into the labor market? And when do you get to a situation that maybe people are using the word stagflation?
That has to be a concern at this point. I think that and this is a conceptual problem that has always puzzled me about the way that the Fed talks about these issues, because you would have thought that they learned their lesson from the 70s. Remember, stagflation was a phrase that was coined, I think, in the 70s. It really became very popular then to describe this condition where you could have a stagnant economy, but also high inflation. And that was such a surprise in that era, because a lot of the Keynesian theories that people had worked from up to that point had assumed that inflation was something that you would only experience if you had a growing economy, in fact, an overheating economy and very strong employment growth. And so then you would be surprised if you ended up in the situation where the prices were still going haywire, even as employment was starting to suffer and there were signs that the economy was slowing down. And here we are pretending to be kind of surprised about that again. But I think that the Fed's assumption up to now has been that its target is the labor market. I mean, remember Jerome Powell was talking for a long time about how he needed to reduce the number of job vacancies in the economy as a way of cooling the labor market. And then that sort of cooling of economic activity and job creation would be the thing that would control the inflation. The Fed never actually thinks very much about potential issues like growth of the money supply that, monetarists might also suggest has an influence there. And the Fed doesn't also oddly think very much about the financial system and the way that dynamics in the stock and debt markets might influence some of this inflationary behavior. And that sets them up for failure, because I think that the great risk now is that, they are looking at the labor market to achieve something that you might not actually be able to achieve by influencing the labor market, bringing inflation under control. They're going to miss all of these really troubling dynamics that will start developing in other parts of the economy as we necessarily unwind a lot of the monetary expansion and the various financial excesses that generally tends to encourage somewhere in the economy. I think that the real risk here is not necessarily that the Fed triggers a recession on purpose, which is kind of counterintuitively what they're really talking about doing. They're talking about deliberately trying to suppress employment as a way to control inflation. I'm not sure that that on purpose part is the great danger. I think that the real danger to the economy is the by accident part of what the Fed is going to end up doing here. The fact that their belated monetary tightening sets in motion a big unwinding of a lot of the excesses that they've encouraged up to now. And that unwinding in the financial system or somewhere else is the thing that bleeds into stagnation or recession on Main Street.
Yeah, all of which is a reminder of why inflation is so dangerous. It's always incredibly easy to get into it and incredibly tricky to unwind it. Thank you, Joe. Thank you, Alicia. Thank you all for listening. We're here every day. Please send your comments to pwpodcast@wsj.com. And if you like the show, please do hit that subscribe button.